Good morning. Welcome to Coffee with Connie, where we try to provide you with all kinds of information and experiences that we've had with the real estate buying and selling process. Things that you may or may not know, things that you may have experienced but wanted some more information on. So a couple of days a week we try to get together and give you all kinds of information that we experience through the real estate buying and selling process. So thank you so much for taking your time to tune in. I'm Connie Foote with Foote Title Group, where we protect your home ownership. Hey, Ollie, how are you? Good morning, Pam. Good morning, Bob. Thank you guys for your time this morning. So this morning I wanted to talk to you about those expenses and the things that happen when you own a piece of real estate. You know, a lot of times we think when we calculate all our numbers for the very first time home buying, or maybe it's not even the first time home buying, maybe it's the second or third time, but you didn't have as much of an experience with this. So when you buy a house, you calculate all these things in your budget. You figure out how much it's going to cost to have the electric, how much the water's going to cost, how much the mortgage payment's going to be, how much are your property taxes, how much is your insurance, how much is it going to cost you to feed yourself, how much is it going to cost you to take care of the landscaping around the property. So lots of different things that go into when you buy a home that you may be budgeting or thinking about when you're buying that home, when you try to decide what you can afford. And so everything comes together and you decide that all of the expenses that you've calculated for this particular property. Hey there, good morning, Miss Carla. Thanks for tuning in. So you've taken the time to budget and calculate what all of your expenses are going to be, and you say, okay, good, I can afford this home as long as I'm able to get it at this mortgage, this interest rate, borrow this amount of money to be able to purchase it because I have this much money to put in myself. And you calculate all those numbers, and probably not by yourself. Your realtor probably helps some. Your mortgage lender helps some. And you get everything all added up the way that you need to, down to the penny probably in most cases. And you say, all right, my mortgage payment is going to be this. I can afford this at this interest rate. I'm borrowing this much money so I can afford to buy this house. And so you get all settled and you say, okay, good. Now I can afford my $200 electric bill. I can afford my $50 water bill. I can afford my telephone bill, although I guess most of us don't have a telephone bill tied to our home anymore, right? So I can afford my cable. Well, we all know that's in there and that's really expensive. So you're taking into account all of these things. You decide to go ahead and purchase this home. You go to closing. You're at closing. Everything is like you thought it was going to be. The mortgage lender disclosed to you exactly what that mortgage payment was going to look like. And yep, everything looks great and we're all good to go. And then you're in your home for some period of time, traditionally probably 6 months to a year, maybe a little bit more. And then your mortgage payment starts going up and you say, wait, hold on, put the brakes on. I thought my mortgage payment was a fixed rate mortgage, and how could this change? I mean, yeah, I'm making a little bit more money this year than I was last year, but I wasn't anticipating putting it towards my mortgage payment. I already had that calculated at a particular number. And then the year after that, it goes up a little bit more. And then, and as you may see, it sometimes will go up a little bit, sometimes a lot. So what is this? Why does this happen? Because I can't really afford this because I looked at all of these different factors, and that's why I got a fixed rate mortgage, so I wouldn't have this kind of a problem. So let's talk about that for a second. So when they calculate your mortgage, your mortgage payment is not only the cost to repay the loan, the principal and the interest that the lender is charging you, but it also, in most cases, includes your property taxes and your property insurance or your homeowner's insurance. And the reason for this is a couple of things. With respect to the property taxes in all jurisdictions are a first lien on the property. And what that means is it doesn't matter who else you owe, how much you owe them, or how long you owe them for. If you don't pay your property taxes, the tax man can come and sell your home at a tax sale. Just that, just like that. Now, there's obviously some legal steps that they have to take, but that is first. Well, if that's first, and let's say your property taxes are $1,900 a year, and let's say you are borrowing a mortgage of $280,000, who do you think is going to make sure that their money is protected because they're loaning so much money? That lender says, I'll loan you this money, but here's some things that are going to happen. All the documents that you need to sign at closing, all the approvals that you need in order to be approved for that loan. And at the end of the day, we are going to make sure those property taxes are paid, because if for some reason you don't pay them, we're not going to lose this mortgage because you didn't pay the property taxes and the house gets sold at a tax sale. So the property taxes are first, so the lender requires that that is included in your monthly mortgage payment. The other thing that's included is your homeowner's insurance or your property insurance. And the reason for that is because, again, they're loaning you a heck of a lot of money, and if for some reason you do not make that payment for that insurance, you forget, the bill gets lost, you can't afford it, whatever it happens to be, and that house burns down, has a tornado, of course we're all seeing a lot of that right now. Unfortunately, this great spring weather comes with some scary stuff. But a catastrophic thing happens to your home, and that $280,000 loan is no longer protected because you forgot to make your homeowner's insurance payment. Maybe you make it monthly, maybe you make it annually, but you forgot to make that payment, and now that mortgage is not insured. So, or that home's not insured to protect that mortgage. So the lender's going to make sure that they collect and pay the property taxes and the homeowner's insurance for your property. Now, what they do is they look at the annual bill, the tax bill and the insurance bill, and before closing, you know, we gather all that information. The lender, we and the lender look at those things. We provide them with that information based on what's public record or what you provided in your insurance bill, and then the lender determines how much they're going to collect each month. And typically what they do is take that bill, divide it in 12, because they collect it once a month and the bill's only due once a year. Or if you have property taxes that you pay semi-annually, the same thing is true because you're just paying them twice, but it's still, they spread it over a 12-month period. So they take, let's say that, I forgot what I said, $1,600 tax bill, and they divide it by 12. So let's say a $1,200 tax bill for quick math. So you're talking about $100 a month is added to that mortgage payment. And then you have your insurance. And let's say your insurance is, let's just say for argument's sake, your insurance is $1,200 a year too. So you have $100 for your insurance that's added to that principal and interest payment. So now your mortgage payment that was $2,000 a month is now $2,200 a month. And the reason for that is, as I said, the lender wants to make sure those bills are paid. Now, that is what it costs you each month until that property tax bill increases or until that homeowner insurance bill increases. When that increases and the lender gets the new bill, the lender is then going to increase your monthly mortgage payment because that they want to make sure that that's paid, and they've got to collect that to make sure that that amount's in there. Hey, Karen, how are you this morning? Hope you guys had a good time last night. It looked like a lot of fun. Hey, Barbara, good to see you and great to connect with you. Thanks so much for tuning in. So when you think about your monthly mortgage payment, it's not just that fixed rate principal and interest. Now we're talking about a tax bill and an insurance bill that can change every year. Now, we all know our insurance doesn't change very much unless you have some kind of catastrophe. So spreading it over 12 months is not going to make a significant difference. But the property tax bill could. I mean, if your jurisdiction decided they needed to raise capital for something and they decided to increase your property taxes significantly, then it could affect your mortgage payment in a kind of significant way. The other thing with respect to property taxes that you have to understand, and this is a little confusing, but the lender is collecting the property taxes based on what the bill was last year. So think about that for a second. What was the bill last year? Now they're collecting money every single month to pay the bill that's going to come due this year. So they're collecting it based on last year's bill. But if the amount has increased and they don't know it, the property tax bill comes in at the end of next year and they've been collecting enough to pay this year, they're going to have a shortage. So then they're going to increase your mortgage payment to cover that shortage. Plus, they're going to increase your mortgage payment to cover what that bill will be the next year, which you haven't been collecting enough for. So I know that sounds a little bit confusing, but the problem is because they collect it from you based on last year's bill, then you can get a little bit behind. So now you've got those two factors at play as well. Sometimes the lender will give you a statement, well, usually they'll give you a statement at the end of the year saying, this is how much your taxes and insurance bill were, and this is how much we've collected, and have you been paying enough into that account to make sure that those bills are secure and paid? And if not, they usually give you a catch-up. So if, let's say, you had been paying enough into it, but the shortage was $300. The old bill was $300 less than the new bill. And so what they may do is say to you, you can catch that $300 up in one payment, so we won't add it to your monthly payment, but we're still going to increase your monthly payment because now we've got to collect based on that $1,200 tax bill plus $300. So we've got to collect on a $1,500 tax bill now. So it's going to ultimately increase your mortgage payment, maybe just not as much if you made that one-time payment for that shortage that they're sitting on. So those things are going to change constantly. Hey there, good morning, Cecilia. How are you this morning? Hey there, sweetie. Thanks for tuning in. My very helpful, successful cheerleader of a husband. He's just amazing and helps me stay on track and thinks about things and helps me share our information. So thanks for tuning in, sweetie, and thanks for sharing. I love it. So your mortgage payment, as I said, you're at this fixed rate mortgage, which is great, but now you've got property taxes and insurance that are going to fluctuate for the whole life of your loan. So you need to put a little bit aside, just like you do with some other things for home ownership. You know, potentially things can go haywire. You may have some windows that end up having a problem. You may have a heating and air conditioning system that needs some work or replacement or whatever. Don't leave yourself short, so have some money aside. And the same is true for this kind of situation. That mortgage payment is going to change a little bit because those taxes are always going to change. And the insurance is always going to change a little bit. But the taxes are probably going to change enough to affect your payment, not uncomfortably, but it will make it go up. So this came up, and as I try to tell you guys a lot of times, is this, the reason I was talking about this morning is this came up with somebody that I'm that's very dear to me, asked me about refinancing. They were at a really low interest rate, but their payment keeps going up and they couldn't figure out why. So we talked about it a little bit, but refinancing in her particular case isn't really going to be a beneficial thing because the interest rates are higher now than when she originally got the mortgage. So yeah, she's going to get her payment probably settled a little bit, but it's only because of the taxes and it's eventually going to change anyway. So she'd be better off not paying those closing costs to do it again because she already has a lower interest rate and putting that money aside to recover those taxes as they increase. So, you know, there's a lot of things that change and go on with with owning real estate, and you just need to make sure that you have a little bit aside, don't cut yourself short, and know that that mortgage payment's going to change a little bit because of those things. And if you hear the word escrow at closing, before closing, after closing, that's that account that the lender saves that money in for your taxes and insurance. It's called escrow. It's a protected savings account. So they can't do anything else with that money that they've collected from you and they're saving to pay those bills, except exactly what they're set for, which is to pay your taxes and to pay your property insurance. So they can't even take some from someone else's escrow, even though they may have it all in the same account. It's a protected amount of money specifically for that fact. So that's what escrow means. And if you have any confusion or questions about that, as with anything we talk about, please reach out and let me know. I love the questions. They help a lot. They help me. They help everybody else that watches. So I love the questions. Please reach out and let me know if you have questions about this information or about anything else we're talking about. And let me leave you with two things. As I've said a lot, I constantly am adding information on our website because I really believe that all the information we talk about and all the resources I can give you to help you answer questions makes you happier, makes the process easier for you, and makes you more successful in finding the home that you want at the right process and the right price and the right situation. So go to our website, www.foottetitlegroup.com, and Foote has an E on the end. There, if you're a buyer or a seller or a realtor, you just pop down that drop down and go to the resources tab, and there's all kinds of information there for you. So hopefully I helped you with some good pieces today. We had a piece of content that just launched earlier this week. It is called the 10 Most Frequently Asked Questions About Your Home Closing. So you can go on and download it on our website. Right on the front page, there's a What's New. You can click on that and download it. You can find it on our social media. We've been emailing information about it. So there's all kinds of information there. And this is a great piece of content that you're going to want to check out. So hopefully I helped you with some good information today. I really look forward to talking to you a couple times a week. Coffee with Connie, where we explore all things real estate and hopefully give you some information you need. I'm Connie Foote with Foote Title Group, where we protect your home ownership and make your closing process simple and easy to understand. Have a great day, everybody. Thanks so much for tuning in. Bye-bye.